We have a market today which feels superficially like 2000. And I think it's going to play out initially like 2000. And then, unfortunately, is going to phase, as he suggests, into the 70s, where deflationary effects on the economy and the stock market will result in a world rather like the 70s, where all assets are simply much lower priced than they are today. A word on inflation, too. I completely agree with Ray on short-term problems, which I would summarize as monetary and general Federal Reserve overstimulus for 30, 35 years. The war and COVID, all of those three influences guaranteeing that we have relatively intractable problem in the short to intermediate term. But what worries me is the longer term arguments for inflation, which is one, we are running out of people. In China, where the 500 million extra farmers precipitated globalization, they have now had diminishing cohorts of 20-year-olds for 20 years. And they are guaranteed, since they're alive now, we know the baby cohorts are dropping like a stone. They are simply going to have a shortage of labor, as is the developed world together. That is not a trivial block, the developed world plus China. All of them will be squeezed for labor. After the bubonic plague, they had a 100-year honeymoon period in which wages went up so much it wasn't reached for another several hundred years in the Industrial Revolution. And we are entering a period where labor is simply scarce, which feels to me inflationary. And at the same time, we have a scarcity beginning in resources. I did freely admit, not in our conversation, but elsewhere, that I wasn't quite as certain about this bubble a year ago as I had been about the tech bubble of 2000, or as I had been in Japan, or as I had been in the housing bubble of 2007. I used to think then in terms of near certainties. This time I felt highly likely, but perhaps not nearly certain. Today, I feel it is just about nearly certain. I think the crazy behavior, the peak of crazy behavior is behind us. I really do. I think we're now in the buy the dip mode, which the super bubbles specialize in. You don't have 2 years of buying frenzy dying overnight typically. So even in 1929, you had some magnificent rallies. And buy the dip is the watchword of practically every brokerage house out there. And it always is. You never, almost never, have a major brokerage house say, the game's over, guys, duck. And we keep an original, unusual index at GMO. It's 36 equal weighted important, the most important commodities. So it's not dominated by oil. And it showed a declining pattern for 102 years from 1900 to 2002. And yes, it was interrupted by World War I and World War II and OPEC. Why wouldn't it be? But it wanted to go down. It went down 70%. It took the index down to 30. Today, 122 years later, the index is down 10%. It has gone to 90. The average important commodity has just spent the last 20 years going from 30 to 90. It has tripled. The reason is, of course, the growth of China, but I believe, fairly passionately looking at the data, that it also represents the intrinsic scarcity, the war between deeper wells, worse iron ore, etc. It doesn't happen. The commercial imperative is overwhelming to stay bullish. It's how you make money. The trend line, being slightly generous, is 2,500. And most of the great bubbles, the super bubbles, go below trend and stay there for quite a while. In the Greenspan era, that tendency stopped. In 2000, yes, the NASDAQ came down 82%, which was fairly brutal. Amazon came down 92%. But the Federal Reserve raced to the rescue so loudly and strongly that they stopped the decline in the S&P at trendline. It only declined 50%. 50% is a hell of a big decline, but it was only enough to get it back then to trend. This time trend is at most 2,500. And I would expect, even if the Federal Reserve tries to do the same, it will be hard to prevent the market from declining to that level. And of course, it declined very quickly, 50% in 1929. It declined 50% in 3 years in 2000. And the housing market, which was another great American super bubble, went all the way back trend in 3 years. As I said a year ago, I think they'll do pretty well by selling. The risks of a debt bubble breaking and the risks of an equity bubble breaking have simply not been understood by our Federal Reserve since Paul Volcker. They are incredibly naive. They haven't even got a clue. They're not even interested in the idea. The idea of now saying, oh, the US housing market has never declined. It merely reflects a strong US economy. Alan Greenspan encouraging, et cetera, right through until today. They don't realize that they're playing with such fire. I said, you can't call these events to within a few months. And at another point, I said, history says that when you reach this level of craziness, the market tends to break within a few months rather than a few years. And I think with hindsight, the market started to get distinctly weaker about 10 months after we talked. So that's a few months plus a little. And this has been exactly how the great bubbles have broken. The blue chips, the S&P 500, have kept strong right up to the last second, and wave after wave of the stocks that had made the real running peel off and drop. In 1929, the flakes were down for the year before the market broke. They were down 30%. The year before, they'd been up 85. They had crushed the market. The really classic example of this is the Russell 2000, which is stock number 1,001 to 3,000, multi-billion-dollar companies. They're a serious enterprise. In the last year, they are down. They have not made any money at all. The S&P's made 23%. The Russell 2000 is meant to go up about 1.2 times the market. In a bull market like you're saying there was, it should have been up about 30%. It wasn't even up recently. This is a huge divergence of a kind that has never happened other than the super bubbles of 1929 and 2000. 2000, you may remember, the growth stocks peeled off and were down 50%. The S&P was flat, which meant the remaining 70% had risen 20%. This is an enormous divergence, and it happens on the upside for the blue chips. So this is it's almost eerily classic. And we have been checking off this list all year. When I sat down a year ago, we had seen the accelerating phase that you need in a bubble. That had taken place last year with the NASDAQ up over 100 from the low, but also up 58% from December of 2019. So even granted that COVID decline, it was a hell of a year. It was a year of acceleration. And the NASDAQ has started to weaken relative to the blue chips. The Russell has started to weaken much more so even than NASDAQ. I would say clearly more. When they do well, it puts a burden on the rest of the economy, and they do bad. So there is a very strong case here for a resource portfolio. On resources, just a point that the last time we had a super bubble in commodities, there were very large new mines waiting to come online. What has happened since the 2011 crunch, when China slowed down in its heavy industrializing and the growth rate of iron and coal dropped from double digit to zero, dead flat for 3 years in a row, breaking the back of the resource industry. They have not done any capex. It takes 5 to 15 years to bring on a mine. They have not been doing this. There are no great reserves of lithium, cobalt, copper, nickel, even iron ore to come online this time. And everybody knows it. If you look at the need for these, particularly green metals, greening metals, it doesn't compute. There are no backup resources. And that applies right across the length and breadth of resources. They have not been capexing, even in oil and gas, for the last 10 years, to a remarkable degree.